This chart shows exactly what happens to most traders when they follow one of the most common pieces of market advice. The RSI is below 30, it's oversold, time to buy. You see the price drop, the indicator flashes a signal, and you jump in expecting a bounce. Instead, the price keeps violently crashing. An RSI reading below 30 is not a promise that the market will reverse. In many cases, it is a liquidity trap. The institutional market makers operating behind these doors know exactly how retail traders are trained. They know an RSI dip triggers an automatic wave of buy orders, creating a pool of liquidity for large players to offload their positions at better prices. To survive these market conditions, you have to read the data differently. By the end of this tutorial, you will have a strict, volume-backed 5-step checklist used to filter out these traps and identify the specific signals of a market finding its floor. Before we get into step 1, prepare your workspace. Open your charting platform and load 3 specific tools: the standard RSI set to a 14 period, your volume indicator, and the 200 period moving average, or MA200. If you rely on an indicator without reading the broader market context, you don't actually have an edge. You simply become the market's exit liquidity. Let's fix that. Step 1 is filtering the macro trend. Before you even look at the RSI, you must locate exactly where the current price sits relative to your MA200 line. If the price is trading above the MA200, you are in a safe condition. The overarching long-term flow of money is positive. In this specific upward trend, an RSI dipping below 30 is likely a high-value temporary pullback. The larger market momentum is on your side. But look at this line chart showing the danger condition. The price is trending steadily downwards, sitting far below that thick MA200 line. The overall trend is deeply negative. Down here in the lower panel, the RSI dips under 30, but the price line continues to plummet. Using RSI as a standalone buy signal in a downtrend increases the risk of entering a trade that has no institutional support. Once you establish the trend, you move to step 2, locating the market context. An RSI reading needs to happen at a logical, structural price level. It means nothing if it triggers in random empty space on your chart. Watch what happens when we add structure to this chart. An RSI hitting 25 in empty space offers 0 structural support. However, when we overlay a historical demand zone, the dynamic changes. The falling price ignores the oversold reading entirely until it physically intersects with this shaded box, a proven area of previous buyer interest. RSI numbers are entirely meaningless unless they mathematically align with both the macro trend direction and the historical price structure of the asset. With the context set, we move to step 3, spotting bullish divergence. This is the exact technique professional traders use to measure when seller exhaustion actually begins. This split view diagram illustrates the visual requirement for bullish divergence. Up top, the candlestick chart drops to form a distinct lower low, but directly beneath it, the RSI line angles upward, creating a higher low. Notice the contrasting angles of these two trend lines. The physics of this divergence tell a clear story. Even though the price is physically dropping, the raw momentum driving that sell-off is actively dying out. The sellers are losing their grip. But seeing exhaustion is not a reason to enter the trade. Step 4 is the trigger. The mistake many make is hitting the buy button while that RSI line is still pointing downward into the unknown. Here is your exact execution trigger. You must wait patiently for the RSI line to bottom out. Then, watch for the precise moment it arcs upward and physically crosses back over that dashed 30 line. Buying a dropping RSI is like stepping in front of a speeding train. The confirmed cross back above 30 is a signal that the immediate downward momentum has stalled, providing a clearer entry point than simply guessing where the bottom lies. Finally, we reach step 5, volume confirmation. This is the ultimate non-negotiable filter that separates a high probability setup from a trap. Take a look at this chart reconstructing the 2022 Bitcoin crash to see exactly how a trap forms. The price is dropping and the RSI is clearly sitting below 30. But look down at the bottom of the screen. Those red volume bars are massive and they are expanding as the price falls. If you see this, you abort the trade. This specific pattern is called capitulation. big, expanding red bars mean institutional money is actively dumping assets in a panic. When panic takes over, an oversold RSI reading becomes irrelevant to the current price action. Now compare that trap on the left to the criteria for a genuine reversal on the right. Notice how the price still drops and the RSI is still below 30. But the red volume bars at the bottom progressively shrink and fade away into nothingness. Fading volume represents total seller exhaustion. The supply of sell orders has simply dried up. With no more downward pressure, buyers can step in and reverse the trend with less resistance. RSI is a thermometer measuring the current temperature of momentum. Volume is the actual heartbeat of the market. Without volume confirming the exhaustion, an RSI signal lacks the necessary evidence of a trend shift. This graphic shows your complete 5-step confirmation checklist. Take a screenshot. 1. Ensure the trend is above the MA200. 2. Confirm the price is at a historical support zone. 3. Identify a bullish divergence. 4. Wait for the RSI to cross back above 30. And 5. Verify the sell-off has shrinking volume. Requiring all 5 boxes to be checked changes how you interact with the chart. You are no longer reacting to a single number, but executing a plan based on a cluster of evidence. Here is your immediate next step. Open your charting software. Scroll back to the 2022 Quickdo crash and manually locate 3 separate instances where expanding volume proved an RSI oversold signal was a trap. Train your eyes to spot the fakeouts. The market relentlessly punishes those who trade off automated indicators, but it rewards those who have the discipline to wait for the complete narrative to unfold. Keep your criteria strict, wait for the confirmation, and trade the facts.